Right. Good morning, you magnificent melon heads. I hope you are well. Hi, mom. Hi, dad. I love you guys. Happy Tuesday morning, everybody. I hope you guys are ready because this morning starts this nutty week. We have got just earnings after earnings after earnings, and then the Fed, and then the economic data. And it's all leading up to that not recession, recession, transitory recession, whatever you want to call it, that we all know we're in. I guess it's only a big R word when the other party's in charge, but we all know that's coming on Thursday. We get some more economic data today that is an input to that. We'll see what that looks like. So just it's going to be a busy week, folks. There's probably going to be a lot of live streams this week. I'm going to live stream Jerome Powell's press conference tomorrow. There may be some spontaneous live streams. I may do the GDP one. I don't know. I'm playing this one by ear, but I am eating my Wheaties this week because there's just so much going on. And look, this is going to make or break the direction of markets. We're kind of in this bear market rally right now. We've got this little bounce going. It does it survive this week? I don't know. Don't know. So far, the news today, not terrible this morning. We've had a couple of earnings. None of the big dogs have reported earnings yet. I mean, there's some big companies, but not none of the tech giants have come in. So far earnings have mixed. We got a big warning from Walmart last night. That's a very bad sign. So overall, I'd say the news is still in the negative direction. Is it negative enough to send us markedly lower? I really couldn't tell you right now. But for that, let's just shrink my melon of a head. Let's take a walk through the indexes and see what is going on in markets this morning. It looks like the Dow is set to open lower by 146 or about a half a percent. Not a huge drop for the Dow. S&P is set to open down 21, also a half a percent, and the Nasdaq is set to open down 82 or 0.67%. So indexes all heading lower this morning, not significantly lower. So kind of a muted response so far. Now here is the chart. I drew this during my live stream on Friday for you guys, and this is the descending wedge pattern that the Nasdaq had just recently broken out of. I'm not going to take you through the whole chart here, but we have broken out of this channel. We've back tested and passed that back test. The level to watch, at least in my technical opinion, is 12,300 on the NASDAQ. A move above that with any kind of volume means the NASDAQ is heading significantly higher. My price target, if we go above that, would be 14,000. Now, I don't think that happens. I think we still head lower this week, but that's the technical point I'm watching. If we go above that 12,300 line, then I think we're heading significantly higher. If we fail and we head back down into this channel, then this sell off that started in January is going to head lower, possibly even pick up steam. Taking a look at the commodities this morning. What is going on in commodities? We've got gold is lower by a couple of bucks. Silver is about 18 cents higher or 1%, currently trading at 18.51. The base metals got copper is up a nickel, platinum and palladium are down a little bit. Crude oil up a buck 50 at $98, still under 100. Natural gas, big move in US natural gas this morning, up 50 cents or 5.7%. But the big news this morning in energy is not necessarily US natural gas, which I mentioned is up 50 cents. That is a big jump for US natural gas. But check this chart out. ICE Dutch TTF natural gas futures. This is natural gas prices over in Europe, up 18 bucks overnight or 10%. And this is on news that the Europeans had reached an agreement. It's kind of weak sauce about curtailment of natural gas flows, especially after the Russians, they restored flow through the Nord Stream 1 pipeline at about 40%. And then yesterday they cut that back to 20%. So still some games being played with the natural gas flows in Europe. Not a good sign for Europe this winter. And if it's the global inflation issue that you're worried about, then this is the chart to watch right here because all roads lead to this. Whatever happens in European energy markets this winter, in my opinion, is going to dictate the pace of the inflation narrative for the next 6 months. And that's going to start in the fall. Right now, the inflation narrative is being dominated by the Fed and by the dumping of the Strategic Petroleum Reserve to suppress oil prices. That's only going to last until about this fall. After that, I think this story takes over. And it looks like right now the weakening of the euro is the only way Europe is going to be able to handle this. So that's not a good sign for the inflation story. Right now, trading at 195, that's euros per megawatt hour equivalent. And just put that in perspective, going back 6 months, here is the big spike. It was only momentarily that we got after the invasion started. Now, way higher, at least in the baseline that settled after that. And if you go back a year, you can see we've had these spikes before, but we never really stayed higher. We've kind of been taking these little steps up every time we get one of these spikes. But this is the most sustained spike that I've seen so far. And it's still heading higher as we speak. So where this actually settles is anybody's guess. This is a big deal for anybody in Europe, folks. If they're talking about mandatory rationing, I think that's the only way this ends is with widespread rationing and the wholesale shutdown of industry in Europe. Keep in mind, European fertilizer plants not running last fall is one of the reasons that we got that runaway grain commodities in the spring. And then that was exacerbated by the invasion of Ukraine. So here's the story that's driving that one. Europe agrees to compromise on gas curbs as Russia squeezes supply. European Union countries approved a weakened emergency plan to curb their gas demand on Tuesday after striking compromise deals to limit the cuts for some countries as they brace for further Russian reductions in supply. Europe faces an increased gas squeeze from Wednesday when Russia's Gazprom has said it would cut flows through the Nord Stream 1 pipeline to Germany to a fifth of capacity. With a dozen EU countries already facing reduced Russian supplies, Brussels is urging member states to save gas and store it for winter for fear Russia will completely cut off flows in retaliation for Western sanctions over its war with Ukraine. Energy ministers approved a proposal for all EU countries to voluntarily cut gas use by 15% from August to March. And this right here, I think, is the weak sauce in this agreement to voluntarily cut use by 15% because a lot of the southern countries in the European Union were saying last week that they didn't want to make these curbs, namely Portugal, Spain, and Greece. Italy was absent from that because we're talking about bailouts from Italy right now. So we'll see how this ends. And they also threw in that the cuts could be made binding in a supply emergency, which, in my opinion, a supply emergency is all but guaranteed at this point. And I got to send a shout out early in the morning to Mr. Mike Bender. Thank you, Mike. I appreciate the super chat, sir, from Robin RC Models. And he says, "Good morning, Jack. Let's see if we at least get some movement for all the money we spend on the show. Energy prices are creeping up again. Also, commodities. Yep, we were just talking about energy, Mike. I do see them creeping up. Now, I have to warn everybody, like as far as the commodities trade, right? For the first half of this year or the first 5.5 months, the commodity trades that was just a money printing machine, right? Oil, food, everything was ripping higher in the first half of this year. And then they started dumping the strategic petroleum reserve. I talked about that a couple of minutes ago. All right. We are dumping 1 million barrels of oil per day on the open market. So much so that it's causing overflow of oil here in the States. And a lot of that is getting exported because our refiners can't even process it. So that means that oil prices are being artificially suppressed by this dumping of reserves. Now, that also means that food, that other metals, everything, almost all commodities to some extent are derivatives of the energy market. And the energy market is artificially suppressed right now. So I don't expect a lot of huge movement in commodities, at least not US commodities, until after the US midterm elections. And those come in this fall because they're going to keep suppressing oil prices because high energy prices is absolutely killing the ruling party in the US in the polls. Now they can only dump so much oil from the Strategic Petroleum Reserve before they run out. They've dumped almost half of it already. So this is a finite resource. They can't do this forever, and they're going to have to replace it eventually. So think of this as a short that needs to be covered down the road. And also keep in mind that the dumping of this oil is suppressing prices. Normally, under normal circumstances, higher prices would have companies out there investing in capex and new production to bring more lucrative oil onto the market and to bring prices back down. That's not happening because of this dumping right now. So when this dumping of the SPR is over, oil prices are going to rocket higher. I think that's going to start in the fall just after the midterm elections. So I don't expect any real fireworks in energy markets, with the exception of that European gas, because that is not affected by the U.S. dumping of the SPR until after the election. That's when I expect some big movement in the energy markets there. And the other thing to keep an eye on is the strong dollar in commodities because that's hurting commodities also right now. The DXY this morning at 107, up about another 0.5%, right? Most commodities are traded in US dollars, and with the dollar getting stronger relative to other currencies, that would be suppressing commodity prices also. So there's that currency headwind that I was talking about in my stream a couple of weeks ago. We're going to see a lot more of that in the days to come. But thank you very much, Mike. I appreciate the super chat and the support of the channel as always, sir. And I agree. I think it's also time to see a little bit of movement in this market. All right, let's get into some of these earnings stories that are going on today. And there's a lot of them. First and foremost, I did a video about Walmart last night, along with Weber Grills and Bed Bath and Beyond. A lot of really bad news for consumers came out yesterday, all within a span of a few hours. I'm not going to rehash that whole thing. If you want to check out that video, you can go ahead and do that. But Walmart right now down 8.3% pre-market, and that all came on this announcement that they provided this update for the second quarter and the fiscal year. And basically, they're pulling in their guidance. Where is it? I wanted to say comp sales source. Here we go. Consolidated net sales growth for the second quarter is expected to be about 7.5 and 4.5% respectively. Net sales, including a headwind from currency of about $1 billion. There's that currency headwind again. And they're saying 1.8 billion by the end of the year in losses due to the currency exchange rate. And operating income, they're expecting it to decline 13 to 14% for the second quarter and 11 to 13% for the full year. And adjusted earnings per share, they're expecting to decline 8 to 9% for the quarter and 11 to 13% for the year. So inflation killing Walmart. And what it comes down to is their customers, they're spending more money on groceries, which is a lower margin business for Walmart, and they have less money to spend on other items in the store. They called out apparel specifically, that they're having a hard time moving apparel and they're having to mark down prices significantly there. Keep that in mind, all you folks who are in apparel stocks, Nike, Under Armour, some of the clothing retailers, people have no money left to spend on clothes after they buy the necessities. So keep an eye on that story. And again, you know, the US is a consumer driven economy. 70% of GDP comes from consumer spending. And the largest retailer, the largest store that caters to consumer spending, Walmart, just told us the consumer's in bad shape. So that's bad news for US GDP. Again, we are so obviously in a recession. It's laughable that they're even debating about it over at the people in DC, but we don't need to talk about them. And well, we already got this one. I have to send another shout out to Mr. Steve Wojtis. Thank you, Steve. I appreciate the super chat, sir, for your support of the channel. He says, Jack, the Bank of Canada raised 100 basis points. What is the probability of the Fed raising 100 basis points or 1%? And what would the market implications be? Okay, so I haven't read the dot plots or anything like that. There are ways to go out and actually see what the consensus estimate is for that 100 basis point rate hike. If I had to guess, I would put it probably at about a 30% probability. I think they're more than likely going to do 75 basis points. And the only reason I say that more than likely is because the last time they did a bigger hike than the market was expecting, they leaked it to the press ahead of time. And we haven't had that leak yet. We may get it in the next day or two. But I think they would have figured out a way to warn us that that was coming if they hadn't done it already. I'm not saying they won't. They definitely could, and that's why I'll give it a 30% chance that they do it. Now, as far as what the market reaction would that to that would be, the market reaction would be significantly lower. All right. Anything more hawkish from the Fed than expected, expect markets to go lower because when they raise interest rates, that means borrowing costs go up. Take the example of Bed Bath and Beyond that I talked about last night, right? Bed Bath and Beyond is a retailer that they're struggling, they're burning through cash like crazy. Well, Bed Bath and Beyond also has a lot of debt. And if the Federal Reserve continues hiking more aggressively, that means a company like Bed Bath and Beyond can't easily access the debt market for cash to keep their business, their money losing operations alive, right? They can't roll over the old debt into new debt because their sustainment costs would go up, their interest expense goes up. They can't just sell more bonds into the bond market. All it just makes it harder for companies to stay afloat if they're not cash flow positive. All right. So a more aggressive hike from the Fed means stocks go lower, probably means The longer dated bond yields may actually head a little bit lower, even though the short term would come up, i.e., more flattening, more inversion of the yield curve. Uh, let's talk about that for a minute, by the way. And thank you again, Steve. I really appreciate the support of the channel, sir, and everything you do. And that was an excellent question about the 100 basis point rate hike, because I have got this chart up here. This is the US 10-year Treasury. And somebody, I can't remember who, or I would give them credit, somebody mentioned this in a comment the other day. Let's shrink my melon a little bit more so you guys can see better. All right. This is the 10-year Treasury going back to about October of last year. And that right there, folks, that is your basic head and shoulders reversal pattern. All right. Clear as day. There it is. And if you're not in a TA, a head and shoulders is pretty much the single worst, most negative chart pattern possible. A head and shoulders is a death sentence for a chart. And it means the chart is about to roll over and head significantly lower. And this is 10-year treasury yields. We peaked up here around 3.5, almost 3.5. And then we came back down. Now, what a head and shoulders usually indicates is if you take the distance between the neckline, which is this red line I drew here, and the peak of the head, then that is the move below the neckline that the chart is predicting. All right. Now, if we have a neckline at about 2.75, and if we have the peak at about 3.5, that means the 10-year treasury yield, if this chart completes, which it's right on the cusp of completing, this chart is telling us the 10-year treasury yield is heading back to 2.0. That's a big drop from here. All right. Now, with the Fed hiking and raising rates, how could we possibly get a drop back to 2.0? Well, that would be a flight to safety. All right. If the Fed comes out more aggressive, or if the earnings this week are really bad from big tech, and if we're definitely into a recession, and if the dollar keeps getting stronger and Europe keeps devaluing the euro to handle their energy crisis, you'll see that dollar milkshake continue to play out as people run to the dollar for safety. And if you're running to the dollar for safety, you might as well buy US treasuries and get at least a little bit of yield on those dollars while you're sitting in them. US treasuries are future dollars. And so you have wealth from all over the world running into dollars for safety to escape the inflation that is worse overseas. And that's driving up the price of US bonds and down the yields. So if the news gets bad enough, yeah, this head and shoulders chart could be telling us that there is a panic in financial markets coming and that US 10-year yield is heading to 2%. That's what this chart is telling me. So it's kind of counterintuitive with the Fed raising rates and quantitative tightening. How could yields be going lower? But look, folks, that's exactly what happened starting on June 14th, right? This peak was on June 14th. That's the day before the last interest rate hike, the day before quantitative tightening started. And yields have come down almost 75 basis points since that day, right? The whole 75 basis point hike, the 10-year yield did that in reverse. The 10-year yield gave up 75 basis points. So maybe that happens again. So that's an awesome question, Steve. And thank you again for the support of the channel. I really appreciate that, brother. Guys, thank you very much. I appreciate all the super chats, all your comments. It really is very helpful. And moving on, we got a lot of earnings. We got a lot of stuff to get through. Coca-Cola came out today. Looks like, well, the markets are open now. So Coca-Cola is up about 1% at the moment. Let's get into what happened. Coca-Cola beats earnings estimates and lifts their 2022 revenue guidance. Now, Coca-Cola, that's one of those safe haven stocks because people buy soda during good times, people buy soda during bad times. It's terrible for you, whatever. While the rest of the market has fizzled, and you see what they did and fizzled, Coke has had a great year. The company's second quarter earnings topped expectations, while its guidance raised bolstered investor confidence that the beverage giant could be well positioned to navigate an inflationary environment. Ticker KO reported adjusted earnings of 70 cents a share on 11.3 billion in revenue. Analysts were looking for 67 cents a share on 10.57 billion in revenue, so a beat on the top and the bottom line. This compared to EPS of 68 cents in the year ago period. So their EPS up a little bit. It has not kept pace with inflation. It's only a 2-cent increase year over year, but it is an increase. They're faring a heck of a lot better than some of the other companies we're going to talk about. And for the fiscal year 2022, Coca-Cola is expected to deliver organic revenue growth of 12% to 13%, up from previous guidance between 7 and 8. So pretty good quarter from Coke. All right. That's one company, doesn't make a trend. Real quick, before we move on to the next one, let's go back through the indexes here because markets are now open. We're going to close the futures. We're going to go to the indexes themselves. Bear with me here, folks. All right, it looks like the Dow has opened down 105 points, so about what the futures were calling for. Let's see what the S&P has done. S&P is down 20 points, still down that 0.5%, so not a lot of movement from the S&P or the Dow. And I thought I had opened the Nasdaq. Where's my Nasdaq chart? There's the Nasdaq. And the Nasdaq is down 137 points or 1.0%, 124 points now. So Nasdaq leading the way lower ahead of big earnings today. Again, keep an eye out for that Microsoft and Google this afternoon. That will inform what the Nasdaq does. And look, folks, I drew this chart a couple of days ago. This is all the companies that report today. I don't have 3M on here. I don't have who else? I guess that was the only one. But we've got Microsoft, we've got Google, we've got Visa. Talk about the U.S. consumer. We'll see what Visa has to say about that. We've got new home sales, consumer confidence, Case-Shiller Home Price Index. There's so much stuff coming out today. It's going to be hard to keep up with everything. But so far, earnings a mixed bag. They're not terrible. Coca-Cola had a good quarter. Walmart had that big warning yesterday. Let's get into a little bit more of these, shall we? Here is General Motors down 3.3% today. GM didn't post terrible numbers. I'm a little surprised to see how bad they are, but let's get into a little bit. GM slumps after Q2 earnings miss, muted outlook. General Motors posted softer than expected second quarter earnings Tuesday and said it would slow hiring and cut spending as it prepared for what could be weaker demand over the final half of the year. Slow hiring and cut spending. That sounds like a recession, doesn't it? That's interesting, but moving on. General Motors said adjusted earnings for the 3 months ending in June came in at $1.14 a share, down 42.1% from the same period last year, firmly south of the street consensus of $1.20 per share. Did I say General Motors earnings weren't that bad? Allow me to strike that record, strike that statement from the record. I don't know what I was thinking. Down 42.1%. That's awful. That is god awful. How is that stock not down more than that? What was I thinking when I said this looked good? I must have got my wires crossed with the Coca-Cola earnings because down 42.1% year over year. That is terrible earnings. Group revenues were pegged at 35.76 billion. GM said a 4.6% increase from last year. That came in just ahead of analyst consensus of 34.52 billion. So look, their revenue is up 4.6% over last year, but their earnings per share is down 42%. Something's up with the math there. Is this adjusted? Yes, this is adjusted earnings. So there's something else going on here. There is some big line item in these GM earnings that I'm missing because there's no way their margins were compressed that big. No way. So something's up with GM earnings. Anyways, 42.1% year over year decline. That's very bad. No wonder the stock is down. They repeated their view that adjusted 2022 earnings will come in at 650 and 750 a share, or 13 to 15 billion dollars, with adjusted automotive free cash flow from operations between 7 and 9 billion. Earlier this month, GM had said supply chain disruptions led to production delays that impacted around 100,000 vehicles, which were missing certain components that will delay their ultimate sales. By the way, I was talking to my sister a few days ago, and she had mentioned that a friend of hers had bought a brand new car that was missing 3 chips. Um, it was chips like the alarm that you're about to hit something when you back up, like these electronic, enhancement systems that these cars come with these days. Well, they're instead of sitting on the lot waiting for the chips to come in, they're selling the cars minus the chips, and they're just writing IOUs into the contract that as soon as the chips come in, bring your car into the dealership and we'll install it for you. Kind of crazy that they're selling incomplete cars. And it kind of reminded me of the end of the movie Gung Ho, where he's got the car with no windshield, there's no engine in it, and you're 6 cars short. Anyway, it's a great movie, by the way, Gung Ho with Michael Keaton. God, the '80s were awesome. All right, moving on. We talked about GM. What about UPS? United Parcel Service down $7 today or 3.8%. Now keep an eye on UPS because UPS handles most of the volume for Amazon. So if you want to know what Amazon is going to do, you can look at that Walmart report and then you could look at that UPS report and you could probably say maybe Walmart's retail business, not Walmart, maybe Amazon's retail business, not doing so well. I keep getting my wires crossed this morning, folks. It's early. I'm not a morning person. Moving on, power through. UPS stock active after Q2 earnings beat revenue per parcel surge. UPS top street estimates and repeated its profit guidance thanks in part to a big leap in the price of domestic parcel revenues. They posted better than expected earnings Tuesday and repeated its profit guidance thanks in part to a big leap in parcel revenues. The stock was pressured in early trading, however, after the parcel delivery group said that domestic volumes would continue to decline over the first half of the year amid surging fuel and transport costs before improving into 6 months ending in December. So there's the inflation narrative again, saying domestic volumes are declining. People are ordering less stuff. Even though UPS had good earnings, that's because they're charging more per package. Their packages, the number of packages being shipped is lower. Bad news for Amazon earnings. Keep an eye on that one. UPS said earnings for the 3 months ending in June were pegged at 325 a share, up 6.3% from the same period last year. That is below the rate of inflation and ahead of street consensus estimates for 315 a share. Revenues were up 5.9% to 24.8 billion, topping estimates of 24.6 billion. Domestic segment revenues rose 7.4%, powered in part by an 11.9% boost in revenue per piece. So there's your inflation. It is costing more to ship things, the higher fuel prices taking their bite out of UPS. But that reduction in domestic volumes, that's a big one. That gives you a clue that Amazon earnings probably not going to come in that good. Now, keep in mind with the Amazon earnings, though, last quarter, Amazon's earnings were god awful, driven almost entirely by that lousy investment in Rivian. They won't have that this time around. So Amazon earnings are going to look a lot better than some of the previous quarters, although maybe still not good enough because now their retail business not looking so good. But remember, most of their earnings don't come from their retail business. Most of Amazon's earnings come from their cloud business, from Amazon Web Services. So the retail business, lower volumes, that could hit their top line, their revenue numbers, but it's probably not going to hit their earnings that much. Moving on, we got two more here. We got McDonald's Corporation. Looks like they're flat for the day. They were up pre-market, and then it looks like they tanked at the close or at the open. Now they're coming back up. Let's see what's going on with McDonald's. McDonald's earnings top estimates. Global sales jumped 10%. Wowza, that's a big jump. But remember, that is not adjusted for inflation. Global inflation is probably higher than 10%. McDonald's reported earnings and same-store sales that topped expectations before the market opened on Tuesday. Company reported U.S. same-store sales rose 3.7%, while international sales rose 9.7%. That U.S. same-store sales of 3.7%, that's actually a pretty lousy number when viewed in light of 9.1% inflation. Keep in mind, that is not keeping up with inflation. That means people buying less stuff. Wall Street analysts had expected same-store sales would rise 2.9% during the quarter, according to data from Bloomberg. Adjusted earnings per share hit 255 against expectations for 246, so it is a beat on the bottom line. Revenue totaled 5.72 billion against expectations for 5.83 billion, so a beat on the top line as well. In the US, sales were driven by menu price increases. There's your inflation again, as well as value offerings, the everyday menu and digital offerings. Digital sales exceeded $6 billion. I don't get digital sales at McDonald's. Can somebody fill me in? What is digital sales at McDonald's? Is that like people ordering on like through DoorDash or something like that? Who orders their McDonald's digitally? All right. You know what? Moving on. So, McDonald's, on the surface, it looks like a good quarter, but when you factor in inflation, sales not keeping pace with inflation. So, I would call this mixed results from McDonald's despite the rosy headlines. And 3M, actually, probably the best out of all of them, probably even better than the Coca-Cola earnings. 3M came in and they're up 670 a share right now, or up almost 5%. So what's going on at 3M? Well, the stock surges after Q2 earnings beat and the healthcare spinoff plans And I think most of that gain is probably off of this healthcare spinoff announcement. 3M posted stronger than expected second quarter earnings on Tuesday while trimming its full year profit forecast and unveiling plans to spin off its healthcare business. 3M said adjusted profits for the 3 months ending in June were pegged at 248 a share, down 4.3% from the same period last year, but 6 cents ahead of the street consensus. Group revenues fell just under 3% to $8.7 billion, topping analyst forecasts for 8.58. So kind of low expectations for 3M. Still a decline in the top line, a decline in the bottom line. It's a bad sign. So I'm guessing that all of this gains in the stock is probably because of this healthcare spinoff. And let's see, where is it? The group also announced plans to spin off its healthcare division, which it plans to complete by the end of next year. The tax free deal will follow its earlier plans to separate 3M's food safety business. So, the company 3M, it's this big conglomerate, and they have all these different business arms, and it looks like they're breaking the company up into pieces. And I actually like to see that because when you break up companies, you tend to add more value than the parent company. When you spin off something, the two daughter companies, the combined stock value tends to be more than the two. And I'm also not a big fan of these massive conglomerate companies because I think once companies get to a certain size, you're no longer talking about economies of scale. Now you're talking about economies of a beached whale, where you get companies that just start blowing through their money at the end of the year. Why? Because if they don't blow their money on stupid things, they'll get a smaller budget next year. So when companies reach a certain size, they actually incentivize waste the way they manage their funding and their budgeting within the company. So I think that's another reason why when you split companies up into smaller pieces, you actually tend to create shareholder value because those smaller companies tend to be leaner than their parent company, even though there's some what they call them synergies when they merge companies. You don't need as many HR, you don't need as much IT. But I think just breaking a company down into smaller pieces where you get better, more efficient business investment, I think that is why the daughter companies tend to do better than the parent. So 3M shareholders being rewarded this morning by that healthcare spinoff. We'll see if that one lasts. And that is where we are at with the earnings this morning. So a mixed bag, not all bad. So let's see what are the indexes doing right now. Looks like the Dow still lower, though not as much lower, down 121 or 0.38%. S&P down 0.68% or 26.9 points. And the Nasdaq still at its low for the day now. Nasdaq down 141 points or 1.2%. So tech leading the way lower today. I guess this is in anticipation of those Google and Microsoft earnings later today. So let's talk about Google and Microsoft for a second. Uh, Starting with Google. All right, let me just tell you, as a YouTuber, Google is probably not going to have a very good quarter. Why? Because my income from this channel is a percentage of YouTube's income from their ad sales. And this time last year, on a per view basis, this channel was making a whole heck of a lot more money than it is this time this year on a per view basis. Companies are cutting back their ad spend big time. And I mean big time. Look no further than Snapchat's recent earnings. They were terrible because companies are not spending as much on their advertising. And Google is probably the biggest advertising company in the world. People say Google is a tech company or Google is a search company. No, Google is an advertising company. That's the business they're in. They sell ads. And ad spend across the economy are terrible right now. Why? Because we're in a recession. Any way you define it, we're in a recession. I don't care what the NBER says. So I don't expect very good things from Google. Now, I have to throw in the asterisk because almost all earnings news prior to today, like the bank earnings and all the economic data, has been very, very bad for the last couple of weeks. And yet, look at this NASDAQ chart. Zooming in here on the last couple of weeks, stocks have actually had pretty much straight up, right? Since the middle of June, stocks have been on their way up. So there's a lot of negativity already built into these earnings. So it is possible you get positive stock movement even on bad news if the news isn't as bad as people are expecting. Now, just again, looking at my own numbers and what the YouTube channel and everything, all the revenue is generating, I am going to guess that Google's earnings are worse than the market is expecting. because it's pretty bad. All right. So that's my take on Google. I'm not calling it Alphabet. It's a stupid rebrand. It's like Meta. What a stupid rebrand. I hate. But on the subject of Meta, otherwise known as Facebook, Facebook is probably the second biggest advertising company in the world. And I expect their earnings to be terrible for the same reason I expect Google's to be terrible, because they sell ads. They're not a social media company, they're an advertising company. The product is their users. All right. Now, Microsoft is interesting because they get most of their growth, most of their income from their cloud computing business. So Microsoft is a pretty good barometer of business investment, of how much money companies are investing in growth. Are they expanding? If they're hiring more, are they developing new software solutions, right? That's the input into Microsoft. PC sales doesn't really inform Microsoft earnings as much as it used to. It still does, but really it's their cloud business that everybody wants to pay attention to. And I'm just guessing, based on some of the economic data that I've been seeing, like the PMI reports and the manufacturing reports coming out of all the various Fed banks, that business investment is down pretty much nationwide across the whole economy. So I would expect that would also hit Microsoft earnings. Now, Microsoft was kind of the bright spot in all the big tech earnings last quarter. Pretty much all of the big tech earnings were terrible last quarter, except for Microsoft. So I don't know if Microsoft can maintain that momentum this time around or not, but that's where I'm at with Microsoft earnings. And that brings us to Visa. Now, I have mixed emotions about Visa because consumer credit is on the rise, right? People are putting their life on the credit cards. But is that necessarily a good thing for Visa? Like we saw in the AT&T earnings, that people weren't paying their phone bills. Does that mean Visa needs to worry about credit losses? Although I don't think Visa takes the credit losses. I think the underwriting bank takes the credit losses. So that may not affect Visa as much. Visa gets their money by fees, swiping fees, percentages of transactions. And looking at that Walmart report and what's happening with Weber Grills and Bed Bath and Beyond, and how all the retailers are struggling right now, I'm willing to bet Visa, which is a very good barometer of the health of the US consumer, probably going to come in with bad earnings as well, because we got one, two, three really bad stories about the US consumer yesterday, all within a span of a couple of hours. And that tells me Visa probably not looking at a very good quarter also. So that's what I'm looking at. That's all coming after the bell. Uh, see what we're going to do after the bell. If I'm just going to do a video about these earnings, or maybe I'll just decide to do a live stream. Honestly, I don't know. I'm kind of playing this one by ear because there's so much that's going to happen over the next few days. And I'm just going to keep up with it the best I can. And let's see. With that, by the way, we have got about 400 people watching right now, folks. I just want to remind you that on Wednesday, I'll be live streaming Jerome Powell's press conference. That is going to be a big one. It starts at 2:15. So stick around for that. Don't forget to like this video, subscribe to my channel if you're new here. And it's almost 10 o'clock. Why don't we take one last trip through the indexes here before we call it a day? The Dow is now down 99. Dow's clawing back some of those points that it gave up at the open, or down 0.29%. S&P down 21, or a half a percent. And the NASDAQ down 120, or 1%. So NASDAQ even clawed back a little bit. Markets are still lower across the board, although not as low as it could have been. Could have been a lot worse this morning. And what is the 10-year Treasury doing right now? Let's refresh this. 10-year Treasury down 10 basis points this morning. Wow. Wow, that's a big one. There's your flight to safety, folks. Down 3.8% on the 10-year Treasury yield. And you will notice we are now below the neckline on that head and shoulders chart that I drew. And, some might say a better technical chartist might draw that neckline a little bit higher than I did. So either way, I'm going to say this head and shoulders pattern just completed. And that's bad news. That means we're heading back closer to 2.0 on the 10-year Treasury yield, even though we've got a rate hike coming in a couple of days. This is a flight to safety. This is investors panicking and buying bonds for safety. It's happened before. See if this keeps up. All right, guys. I want to thank you guys for the super chats. Thank you for coming and watching. Big shout out to my Patreon supporters. Thank you guys for everything you do for the channel. We have our Patreon only Zoom meeting is tomorrow at 5 p.m. Eastern time. We're going to do that a few hours after the Fed's press conference. So I'm sure we're going to have a lot to talk about on that Zoom call. I love the Zoom calls with you guys. It is always a good time. I get my best ideas from some of my Patreon supporters. And I have to send a thank you to Mr. Palmworks US. Thank you, Palmworks. He says, I feel like all the large companies have not fully prepared for the bad debt wave on the way. P&L outlooks are getting less predictable. I agree, Palmworks, and thank you very much for the support of the channel. I don't think these companies have adequately prepared for what's coming. Some of them have. A lot of companies did lock in and refinanced a lot of their debt in the during 2020 when interest rates were down near zero. A lot of companies that were smart took advantage of that. The ones that didn't are going to pay the price over the coming years because I think rates probably going to head higher. They're probably going to stay there for a while. Um, that is borrowing costs. Because another thing to keep in mind is while the 10-year Treasury yield is heading lower, credit spreads are blowing out higher, which means the gap between the 10-year Treasury yield and what it costs companies and individuals to borrow is getting bigger. That's the lenders saying there's more risk in markets. And so we're charging a higher premium for the riskier debt. Credit spreads are blowing out. And that's right in line with what you're saying about the P&L outlooks not looking so good, Palmworks. So excellent comment, and thank you very much for the support of the channel. Appreciate that very much. And there's Miracle Oil. Jack, will oil go up if GOP wins midterms? I think oil is going up after the midterms regardless, because after the midterms, we stop dumping the Strategic Petroleum Reserve. So that alone means oil's probably heading up after the midterms. Now, if the GOP wins, I think we're looking at gridlock, right? Because nothing the GOP does in Congress, if they win, is going to get past Biden in the White House. Biden still got his veto authority. So they're not going to be able to do anything to alleviate gas prices, to alleviate oil prices from Congress, not without the White House. So Biden's just going to veto anything the GOP sends over his way. So all you're going to get is a bunch of symbolic votes, symbolic gestures that end up with a veto and they die on the vine and nothing happens. Gridlock. So oil is going up regardless of whether the GOP wins or not. Maybe oil goes up a little bit more if the Democrats somehow maintain control of Congress, but I don't think that's going to happen. I think there's almost no chance that that happens at this point. I mean, it's things are getting so bad. Team Thanos is just declaring war on people right now with this ESG thing that's going on with what they're doing in Canada with the farmers and the fertilizers. I mean, people have to see what's coming. At some point, I think people have to see what's coming. And Orange Man bad, mean tweets. That's not going to matter when people are starving, when people are freezing in wintertime. So that's just my opinion. Again, I don't want to get too political. I apologize for that. But thank you very much, Miracle Oil. Appreciate the super chat. Thank you guys all. All right. I think I've been going long enough. We got a long day, a long week ahead of us. Eat your Wheaties, folks. And I look forward to seeing you guys on some of these other live streams. And until next time, live small and dream big.